Welcome to vTalkInsight, Market Drivers Daily for July 13th, 2026. Middle East tensions have moved from background noise to a key macro driver, lifting oil, nudging bond yields higher, and weighing on parts of the technology trade. We will focus on how the Strait of Hormuz standoff is feeding through energy and rates, how the AI capex boom is colliding with volatility and funding constraints, and how a pivotal earnings week could reset leadership across equities and credit. Geopolitics around the Strait of Hormuz have shifted from a chronic overhang to an acute supply chain threat, and that change is now visible across energy, rates, and regional equities. Earlier in the week, markets largely treated Gulf tensions as manageable disruption, but tit-for-tat strikes between the United States and Iran, attacks on vessels, and damage to key infrastructure have pushed shipping conditions toward standstill. Observable tanker traffic through Hormuz has dropped sharply, with satellite data pointing to more ships sailing with transponders switched off, a sign of heightened risk aversion and opaque flows. Some vessels are still moving, but shippers face a confusing mix of United States-endorsed southern routes and Iranian-enforced northern lanes, increasing operational risk and insurance costs. Gulf states are warning that continued hostilities threaten severe economic fallout, while repair bills for damaged energy facilities in the region are already estimated in the tens of billions of dollars. On price action, Brent has risen several percent today after already gaining strongly over the past week, with spot levels around the high 70s to low 80s reflecting both disrupted Hormuz flows and wider attacks on infrastructure in Kuwait, Qatar, Jordan, and Bahrain. European gas prices are edging higher. Qatar has delayed parts of its liquefied natural gas expansion, and global refining capacity is lower as Russian product exports and Gulf shipments are curtailed, pushing refining margins toward record territory. This tighter energy backdrop is feeding directly into rates and equities. Government bonds are under pressure as higher oil rekindles inflation worries, with markets bringing forward the probability of the next Federal Reserve rate hike from late in the year if energy stays elevated. European equity futures are down. Asia-Pacific stocks are softer, and travel and airline names are struggling as record fuel costs collide with risk-off positioning, even though some premium carriers are still demonstrating strong pricing power and solid margins. The picture is more nuanced than a simple energy shock. The United Kingdom's FTSE index is finding some relative support from its heavy exposure to oil majors, and a structural increase in output from producers like the United States and the United Arab Emirates is helping to cap crude prices below the kind of triple-digit levels that would trigger a more severe growth scare. Base case expectations still point to some arrangement emerging that eases the most acute shipping strains, but markets are increasingly aware that even with alternative routes, a persistent Hormuz risk premium could keep inflation sticky and leave European corporates and banks more exposed than their United States peers. That sets the stage for where capital is rotating next, particularly into and out of rate-sensitive growth themes, such as artificial intelligence. The artificial intelligence story remains a powerful structural growth engine, but the way it shows up in markets is becoming more volatile and selective. On the fundamental side, chipmakers are still reporting remarkable numbers, yet price action around them looks increasingly like high beta macro trading rather than a straightforward earnings story. TSMC has reported quarterly sales growth in the mid-30s%, with June revenues up well over 60% year-on-year, underlining just how strong AI-related chip demand remains. Forward guidance points to further robust expansion as hyperscalers ramp data center spending, and broader estimates suggest AI-driven capital expenditure could reach several $1 trillion over the next 5 years, concentrated among a small group of large United States platforms. Despite that backdrop, semiconductors are trading more like macro instruments than simple growth stocks. South Korean names, such as SK Hynix, have given back a large part of their recent gains, with the share price dropping sharply from its peak amid profit-taking, stretched expectations, and concerns that the current memory cycle may be ahead of sustainable end demand. Even solid results are not always rewarded. Markets have been unforgiving when earnings or guidance fail to beat elevated expectations, and volatility in leading chip names is now running well above broader indices. Financing the AI build-out is another pressure point. There has been a wave of bond issuance from technology and infrastructure players tied to data center expansion, prompting portfolio managers to rotate out of older holdings to make room for new supply and pushing funding costs higher at the margin. Energy has become a bottleneck too, with data center-driven demand helping lift power input costs to multi-year highs and prompting big technology firms to explore advanced solutions, from grid upgrades to experimental technologies, reinforcing the link between AI, inflation dynamics, and central bank caution. Against this backdrop, the AI theme is evolving from a broad sector beta trade into one that depends more on company-specific execution and balance sheet strength. Some firms benefit from durable advantages in hardware, software ecosystems, or energy access, while others face legal challenges, heavier dilution, or rising competition, and investors are increasingly aware that not every name tied to AI will capture the same share of the profit pool. The next major catalyst will be AI-linked earnings reports and capex guidance, which in turn feed into our final focus today, a high-stakes earnings season. Corporate earnings are stepping into the spotlight with expectations already set high, especially in the United States. Across major indices, year-on-year profit growth for this season is projected in the low 20%, with particular strength anticipated from technology, energy, and banks, and analysts revising forecasts higher rather than cutting them in recent weeks. 5 large United States banks are due to report shortly, including JP Morgan, Citigroup, Wells Fargo, Goldman Sachs, and Bank of America. Bank stocks have already rallied strongly, and consensus looks for roughly 20% earnings growth driven by robust trading, healthier capital markets, and solid lending activity. Positioning, however, is crowded in some names, with popular long versus short pairs around the major investment banks, which raises the risk of outsized moves if results or outlooks diverge even modestly from expectations. Beyond headline beats or misses, the quality of earnings will matter. In banking, the path of deposit costs and net interest margins is central, as stable policy rates can still mean steadily rising funding costs into next year. In cyclicals, oil-linked input costs are in focus, particularly for European industrials, while in the United States, there's growing emphasis on how AI and automation are supporting margin expansion in higher value-added sectors. Recent airline results illustrate how pricing power can offset energy shocks. Delta has reaffirmed full-year profit guidance and maintained high single-digit operating margins despite record fuel bills, helped by resilient demand and the ability to charge more for premium cabins, even as average airfares remain below pre-pandemic real levels. By contrast, in AI hardware and semiconductors, strong reported sales at companies like TSMC have not prevented share price volatility, underscoring that in this phase of the cycle, markets are reacting more to forward guidance, balance sheet flexibility, and positioning than to backward-looking numbers. As this earnings season unfolds, dispersion across and within sectors is likely to stay elevated, making the interaction between results, geopolitics, and rates a key driver of cross-asset performance. The common thread across today's drivers is that risk premia are being repriced, not uniformly, but along the fault lines of energy exposure, balance sheet strength, and reliance on AI-driven growth. Heightened tensions in the Strait of Hormuz are hardening the inflation floor and supporting a higher-for-longer rate narrative, even as structural AI demand underpins earnings in technology and selected cyclicals, and an ambitious earnings season tests just how much good news is already embedded in prices. Watching shipping flows, oil's trading range, AI capex guidance, and bank commentary on funding costs should provide timely signals on whether current cross-asset rotations deepen or reverse. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.